This is joint work with Se-Hung Kim, Jong-Sub Lee, and Juno. So stakeholders all around the world have been increasingly demanding firms to be more conscious about environmental, social, and governance issues. And obviously, firms have responded to this. Over the last couple of years, we see firms more increasingly incorporating ESG issues in their corporate policies. And as an indicator, if you look at the earnings calls and what executives are mentioning, since around 2017, there has been an exponential rise in terms around ESG mentioned in these earnings calls. And it's not just corporations and media, but even the finance literature has increasingly started doing more and more research on how the capital providers are taking ESG concerns into their investment decisions. At the more fundamental level, what's the connection between ESG and financing? Well, there's this basic issue of downside risk. So there's a bunch of literature that shows that being proactive on ESG issues really help protect against downside risk. Beyond this basic financing considerations, especially the shareholders, investors on the equity side, definitely also try to impose their own preferences on ESG issues. And relatedly, there's been a literature which has shown that shareholders have not only demanded, but firms have really improved their ESG practices as a response to shareholders' preferences. On the debt side, there has been a big increase in research focusing on green bonds, including Dragon Tang has a paper on this. What are green bonds? These are debt issued by firms where the use of proceeds are to be directly used on green projects. However, on the bank lending aspect, there is not much research done. This is very surprising given that even today, bank loans form the predominant form of external financing for firms, not just in the US, but across the world. There has been some research, but most of the research has focused on the fundamental idea of given ESG is a risk, how loan contracts incorporate ESG-related risk in their spreads. And then there is a research looking at how ESG preferences of both the lenders and the borrowers influence the matching process between who borrows and who lends to whom. However, there is a big gap in trying to directly understanding how ESG constraints, ESG concerns are directly incorporated in the loan contracts, as well as how loans influence ESG practices of firms. And that's what our paper tries to fill in. So what we do in this paper, we are going to document and characterize the massive growth of the ESG lending market. We're going to look at who participates, what are the incentives. We look at the details of the loan contract. How are they structured to incentivize ESG-friendly policies, and how all of this information is disclosed to the market. What is the effect of these ESG concerns on the loan spreads? What are the consequences of firms' performance on ESG aspects because of the loan? And finally, the big concern about greenwashing. There's a lot of concerns in the media, with the practitioners, in the academic literature. A lot of what is going on is just pure basic empty labeling and not much done on the real front. So we're going to touch upon that. To give a very quick glance, what are we going to cover in ESG lending? We're going to look at two kinds of contracts. In particular, what's really interesting is what is called ESG Link Loans, also sometimes called sustainability linked loans. What are these? These are general purpose loans, where typically the loan spreads are linked to ex-post performance of firms on ESG issues, okay? And of course, there are green loans, which are similar to green bonds, where the use of proceeds themselves are required to be used for green projects. So clearly, green loans are easy to understand, very similar to the green bonds. But within this ESG linked loan space, there are typically broadly two kinds of contracts. Some of the contracts have a loan spread which is directly tied to ESG score by a third-party rating agency like Sustainalytics. This is one such example where the loan spread automatically increases or reduces based on how the firm's ESG score post the loan issuance changes based on the ratings. Another broad way of these ESG linked contracts are where these are typically by more established, more towards very frontier of ESG. These are firms which already have very well practices. They have ways to measure their ESG performance. And the stakeholders in these firms probably have very specific, very targeted areas where they want the firms to improve. And so the loan contracts don't just link to an overall ESG score by a third party, but the lenders and the borrowers agree that they identify certain key performance indicators, which the firms wants to improve upon. In this example, this is broadly to do with employee safety as well as their greenhouse emissions. So they contract upon very specific KPIs. And again, there is a pricing grid where the loan spread will improve or deteriorate depending on the firm's performance around these KPIs. Again, these KPIs are measured, audited, reported by third-party practitioners who specialize in these areas. So these are two ways of coming up or structuring ESG linked loans. What these KPIs give is a lot of flexibility to firms in how they want to approach their ESG initiatives. Let's get to the data. We use Refinitiv DealScan Data. They are the largest source of syndicated loan data covering US as well as the rest of the world. What we see over here is starting from 2016, the first of the green loans popped up in this data set. And in 2017, the first ESG link loan was mentioned. And the timeline pretty much matches with what we can find on the general media. We all know that the first ESG link was issued in 2017 by a syndicate where ING was the lead sustainability agent. What we have here on the left-hand side is the market share of ESG loans in the total loan space covered by DealScan. So by 2021, the ESG loan constitute 12% of the entire lending market. So definitely this is now a big part of the total lending market. And if you look at the growth, it's been just growing exponentially. And as we can see here, within the ESG loan space is the ESG link loan, which comprises more than 90% of the space. If you look at the industries, obviously green loans, we already know they have to be by design concentrated in industries which have green projects. So these are dominated by utilities and some other industries. But in stark contrast, if you look at the ESG link loans, except for a little bit of a bigger share of utilities, the rest of the distribution of the industries in ESG link loans is no different from the distribution for the normal loan, the non-ESG loan. So in many ways, ESG linked loans have kind of democratized the use of ESG loans via general purpose usage and contracting the spread to overall performance of the firm. If you look at the geographical growth, no surprise, these loans started in Europe and they have grown a lot, but North America has taken over, especially over the last 2 years. It's really taken over, and today US is the single largest, as a country, the single largest issuer and user of ESG loans. So the first question we are going to examine is who issues these ESG loans, who are the borrowers, and then who are the lenders. So what we have in our data set is around a little less than 1,200 ESG link loans and a little close to 1,250 green loans. And what we do is compare these loans to rest of the non-ESG, or what we call control loans in our sample. We restrict to the same time period, we restrict to the same countries where ESG linked loans are used, and we restrict to the same industries that use these ESG linked loan. The first thing we find is, well, the ESG issuers are larger, measured in terms of sales. ESG issuers are much more likely to be public firms. If you look at the credit ratings, again, these are healthier firms. If you look at the actual loans, the loan sizes are bigger. So overall, what all this tells us is these are large loans borrowed by economically important firms. If we move on to looking at the structure of the loan itself, ESG loans are much more likely to be in the form of revolving credit facilities, whereas green loans are much more likely to be term loans. This has partly to do with the fact that revolvers are mostly general purpose, whereas term loans quite often have a more restricted use of proceeds, and which are typically what green loans are. Now, obviously, there's a lot of research in the banking literature around the deal structure, around the whole idea of revolvers, term loans, and this is definitely related with firm size and the loan size. So really pin down whether ESG linked loans have a specific preference for revolvers. What we do is a more careful matching, where for each treated ESG linked loan, we identify the closest match non-ESG loan by terms of the deal size. So these are similar size loans in the same country, in the same industry of the ESG loan, in the same year. And these are in many ways very comparable loans, and we still find that ESG linked loans are much more likely to be revolvers than term loans, whereas green loans are much more likely to be term loans than revolver. And as I said, in the literature, what does this signify? Well, the literature has agreed that revolvers are the covenant-heavy contract. These are the contracts where the banks really try to put all the heavy screening and monitoring efforts. This is what the banks really monitor and force. And so to the extent these ESG contracts really have very specific ESG linked features, revolvers are the best way to go about structuring those contracts. There's also a whole literature on relationship lending, how banks use their soft information to monitor their borrowers. And again, the finding is that typically relationship-based lending, a lot of soft information-based lending usually happens via revolvers. So all of this fits in with these ESG-linked contracts really being covenant-heavy contracts and requires a lot of monitoring. When we look at the lenders, who are the lenders? Well, typically the lenders are the largest global banks with operation all around the world. These are really the national champions, the flag bearers of their countries. If you look at the structure of the loan syndicate, who are the players, who are the lending syndicate members? The first thing we notice is, again, these are mass sample where the treated and the control loans are of similar size. And we still find that there are more lead arrangers in an ESG linked loan compared to a control loan. What do we take away from this? Our one conclusion is that probably there's a greater demand from lenders to participate in these limited number of hot ESG linked loans. And so such syndicates end up having a greater number of lead arrangers. The next three things, and these are all related, is that lenders and ESG linked loans seem to be more reputable. This is based on their total market share in the lending market. They are more likely to be global foreign lenders. So again, given that these are the biggest global banks, so they are more likely to be foreign lenders for a given borrower. And again, the main idea here is there's a whole literature which says that there's a typical home bias in lending because of information frictions and other barriers. Looks like in the ESG linked loan market, borrowers are able to overcome that, particularly because they want to borrow from reputable lenders. So that's pretty much in line with who these banks are. Another interesting thing that we found is relationship lenders. Again, going back to what we said earlier about revolvers, we find that the lenders in ESG linked loans are more likely to be relationship lenders who have had past lending relationship with the borrowers. Taking all of this, what can we conclude at this time? If we think about the borrower incentives, it looks like, given these are large, prominent firms, it looks like borrowers are structuring these ESG linked contracts as a way to signal their ESG commitments to their stakeholders. Now, obviously, there's a question whether these signals are credible signals which they want to follow up on, or these are just empty labels, an effort to greenwash. And I'm going to touch upon a little in the next few slides. If you think of the lenders' incentives, definitely there's the basic argument of the lending technology of banks. To the extent ESG is related to credit risk, banks do want to incorporate ESG parameters in their lending contracts. And there's also this whole idea that bank loans have a very special signaling purpose. There's a whole literature on certification role of banks. Just like when banks lend a loan to a firm, it sends a positive signal about the bank's fate on the firm. In the ESG space, there's a similar idea. When a bank is lending an ESG loan, there's whole idea of banks using the reputation, they're using their monitoring skills to certify that this firm is really serious about their ESG initiatives. At the same time, given that it's mostly the largest global banks who have really taken over the ESG-linked lending space, this is consistent with greater pressure from regulators and other stakeholders on these firms, these banks, to really take the leading role in the ESG lending space. And then there's also the related to the greenwashing idea, given that most of these lenders are relationship lenders, maybe they are just aiding their long-term customers in their efforts to greenwash. To be able to answer some of these questions, we dig deeper. First, we look at the ESG loan pricing. Obviously, at the basic level, there's a connection between risk and loan spreads. So what we do is we follow Berg et al. And what we look at is the all-in drawn spread of these loans. And we compare these spreads for ESG-linked loans to comparable non-ESG linked loans. And what we find is, of course, if we don't control for borrower and loan characteristics, we find that ESG loans have a much lower spread. But of course, we know that because ESG borrowers are typically the better, healthier, better rated firms, once we control for all those borrower and loan contract terms, we don't find any difference in all-in drawn spread at time of the issuance. Now, remember, these are ESG-linked loans. No difference at time of issuance means if the firms meets their future ESG improvement targets, the spreads will reduce. In that sense, borrowers do end up saving on spreads if they meet their ESG targets. If you look at green loans, where it's just about use of proceeds, clearly green loans have lower spread than a comparable non-green loan. Overall, what this analysis tells us is that ESG loans do enjoy a pricing advantage. In terms of the green loans, our findings are a little different from green bonds, where typically there is no difference in the spreads. And the argument there is the providers of green loans, the big banks, the stakeholders' incentive there is a little different. They are really being encouraged to push towards ESG initiatives. Maybe the bondholders don't have much preference for those initiatives and don't really want to give any concessions on spreads. Finally, we touch upon the whole concerns about greenwashing. We do find that the quality of disclosure regarding the ESG linked terms in the contracts overall are pretty low. Out of the 1,100 loans that we have, only 50% have really good disclosure about the ESG contract features. Obviously, more publicly listed firms have better disclosure compared to the non-public firm. But in every aspect that we look at, overall, the quality disclosure regarding ESG contract terms is quite vague and intransparent. And over the next few slides, we try to see how the disclosure quality relates to.
Nitish, you're over. You have 2 minutes to finish.
Thanks. So what we look at, the first thing we look at is how does ESG performance and ESG score relate to the quality of disclosure as well as the ESG link loan. So these are different specifications. We're looking at ESG loans, and control loans, ESG scores of those borrowers before the loan issuance as well as post loan issuance. So over here, the general finding is ESG borrowers overall have a much higher ESG scores. This is again asset force scores, so it's subject to some of the same concerns, but we are not really looking at some stock price related stuff here. But we do agree there are some concerns, and our plan is to incorporate, as suggested, many different ratings to investigate this issue. What we find is in the post-issuance period, ESG borrowers, if anything, see their ESG score or components of ESG score, which are probably more objective than subjective, they actually fall. Right? And turns out if we further dig in, most of this fall post-issuance in ESG score is coming from the subsample with poor disclosure. The fall is really very clear here. Whereas if we look at the firms with good disclosure, remember they all have very high ESG scores to begin with. At least they continue to maintain their pretty high ESG scores. So there's definitely some connection between the disclosure, how transparent firms are regarding their ESG contracts and initiatives, and how they perform in the future. As a last attempt, we also look at how stock investors are vigilant to such potential greenwashing issues. We look at stock returns around loan announcements. Now, these are by nature very noisy. Loan announcement dates are always a little vague to figure out. But we do find that overall, there is a positive stock market reaction to ESG loan issuance, which have good disclosure quality, and we don't really find any such performance for poor disclosure. We look at smaller time periods, and overall, the idea is investors seem to be vigilant, and positive stock market reaction is only for good disclosure ESG loans. Finally, to conclude, this market has been growing very rapidly. It's primarily driven by ESG Link Loans. They're widespread, issued by large firms. There's a pricing incentive, advantages there. The disclosures are very vague. We do find that transparency in ESG contract terms alleviates the basic greenwashing concerns that are very important these days. And we do believe that as this market matures and institutional practices get more established, the whole ESG loan market can really take a more central role in the financial sector's push towards making corporations incorporate more ESG policies. Thank you.
Thank you, Nitish. Litov will be our discussant. And I forgot to say, thank you very much to all the discussants. It's a lot of work to discuss at a conference.
Thank you for inviting me to discuss this very interesting paper by Sehun, Nitish, Young-Sup, and Yun-Ho, Litov, University of Oklahoma. Let me start by saying that this is a rather interesting paper and an important question. This paper in particular documents and characterizes the growth of the ESG lending in the form of loans around the world. ESG lending is the issuance of either the general purpose loans, whose terms are contractually tied to a particular target ESG performance, or loans whose proceeds finance exclusively environmental and socially conscious projects, that is the green loans. It's an interesting dynamic that the global ESG lending has grown from about 6 billion following the Paris Climate Accord in 2016 to nearly 322 billion in 2021 alone. ESG linked loans in particular have originated in and are more widespread in countries with civil law origins. And that was a very interesting finding in this paper. Moreover, green loans are more widespread in some legal systems than others, but are more common in countries with stronger environmental regulation. That is the one factor that drives them more prominently. Another interesting finding is that the average deal size of the ESG linked loans is about 937 million, whereas the non-ESG deals is on average $521 million. In contrast, there are no such differences when one looks into the green loans, and majority of them are linked to project financing. The sample also reveals that a large part of the borrowers are essentially utilities. Continuing with the findings, the paper finds a significant and a positive association between the likelihood of ESG lending and the ESG scores of borrowers and lenders ex ante, but does not find any evidence of improvement in those scores ex post. To the contrary, the authors find within borrower ex post deterioration in those scores after the ESG loan issuance. These results are overall consistent with an interpretation of greenwashing, where large borrowers and global lenders, who both have reputational incentives to signal ESG commitment, build on their lending relationships to obtain a certification through explicit ESG loan contracting format, at most, however, maintaining the status quo of corporate ESG performance without any further improvement. So I have several comments regarding this. The first one relates to the relative economic effect. So I think it will be interesting to know more about the relative trade-off that is associated with ESG lending. For example, do firms that pursue the ESG linked loans realize lower returns than they would should they have otherwise acted or otherwise be able to attain? Or do they pay higher rates as a way to pay or compensate for the certification that ESG-linked loans will provide? The paper is not delivering that particular test, and I believe it will be useful to look at this in greater detail. Relatedly, it might be interesting to examine the trade-off that exists between improving the ESG metrics in order to obtain a lower interest rate and the cost of such improvements. It's a simple cost-benefit analysis that the borrower will have to procure in order to be able to benefit from this issuance. Is a larger relative loan size, therefore, and thus a larger incentives to meet the ESG targets set in those contracts, associated with a higher rate of hitting thus ESG target for the ESG-linked loans. Another issue is the issuance if it serves as a credible signal. So the paper on page 27 states that these findings, the findings of the paper, are at a minimum consistent with reputational signaling incentives, but inconsistent with the credibility of these signals. So this raises an interesting and important point. If, as the paper shows, ESG-linked loans are not a credible signal for commitment to ESG, there are several different possible interpretations of the results. The first is that this lack of credibility of the signal is widely known. And ESG-linked loans are not undertaken for signaling purposes. Another mechanism is driving that choice. Alternatively, it is possible that firms undertake these loans for signaling purposes, and the target of these signals do not realize that they are not credible signals. So going forward, I think it would be interesting to know more about the relative trade-off associated with the, this would of course beg the question of why targets of the signal may not perceive ESG-linked loan issuance as credible commitment to green investment. And this is something the paper may wish to further address. Another possibility is that issuers believe this is a credible signal, and the target of the signal, no, it isn't. This would mean that issuers believe they get the benefit from signaling when they in fact do not. This would again require further explanation. And it seems that the paper probably subscribes to the second point of view, that the target of the signaling believes that it is credible when it is in fact not credible. The paper could therefore attempt to explain why a signal that is not credible is being interpreted as such in loan markets. The target of signaling is my next comment. So there is this question of who exactly is the target of the signal of commitment to ESG. The paper speaks often of the reputational effect, but it is not clear exactly whether that is reputation among customers, investors, or business partners. For example, more precisely, what exactly are the economic benefits the issuer anticipate to receive by signaling such a commitment to environmental causes? This paper does make an important contribution nonetheless by providing a lot of descriptive statistics and background information on the ESG lending, but the analysis may further be enriched. I would like, for example, to see more explanation of what leads the firms to choose the ESG-linked or green loans over traditional financing and the trade-off that are involved in that decision. So study the ESG versus green versus traditional loan financing. One way to address the last question is to study the ESG-linked loan to green loan ratio in addition to abnormal ESG-linked loan share and abnormal green loan share in table 4. And there is an interesting dynamic. If you look into that ratio in particular, you can see clearly that the United Kingdom is the lowest such ratio, while other countries like Netherlands, also G7 member, other G7 members tend to have significantly higher such ratio. So what explains that difference? And that will come once again to help understand the answer to the previous question. Next, the actual fulfillment of the key performance indicators that are set forth in those loan contracts. The paper admits on page 27, and I will cite this, we acknowledge that broadly defined asset for ESG scores clearly have limitations and outcome variables with respect to the issuance of ESG loans, whose terms are made contingent on specific and diverse key ESG performance indicators. I mean, this is an issue for an interpretation of the trajectory of ESG compliance during the life of an ESG-linked loan. I would like to know more about the paper's reasoning for not following the actual fulfillment of the KPIs of each loan. Is that a data availability issue or something else? I would also be very interested in learning more information or at least anecdotes about how the process of obtaining an ESG-linked loan works. Is this something that is typically forced upon the borrower as part of this revolver application as a condition of obtaining the revolver? Or do firms suggest these KPIs in order to facilitate their signaling of commitment to environmental causes? Another minor point is the case of bank borrowers. Banks are prominently lending to other banks or financial institutions through the ESG-linked loans. That's about 19.7%. That's the largest industry volume in the ESG-linked segment, or through green loans, the second largest industry volume in that segment. What explains the large share of banks in the sustainability-linked and green loan markets? I think that's an interesting question. Revisiting the trade-off between ESG-linked and green loans notably, the price of green loans is lower, while the price of ESG-linked loans is not. Why then bank borrowers do not prefer green bonds, as is the case of utilities when they borrow? So these questions are of interest given the interesting dynamics that the paper already presents to us. The issuance's effect on greenness. The paper finds that ESG-linked loans issuance leads to lesser ESG or just environmental scores post-issuance. Now, this finding is opposite to what Flemmer finds of the post-green bond issuances of significant improvement of the ESG ratings and reduction in the CO2 emissions. So given the opposing findings of ESG-linked loans and green bonds, one therefore can also ask the question if indeed green loans have a differing effect on the ESG rating too. And I didn't see the green loans per se as a category, repeating the analysis in table 10. It will be an interesting thing to look at and discuss. And the paper could also benefit from explaining that pattern. And since Flemmer uses firm, country year, and industry year fixed effects, I think it will be fair to also include those in the paper here. Next,
we're going to have to wrap it up.
Okay, yeah, I just wanted to say that there is this very nice proxy for climate change exposed firms in Sotner et al. That could be used to study the dynamics of the cross-section. So let me just conclude that overall this paper is very interesting, very well narrated, adds a lot to understanding of ESG linked and green loans. It asks a lot more questions than it answers, and I think this is a good thing. I learned from it and recommend everyone to read. Thank you very much for giving me the opportunity to discuss.
Thanks, Lubo. That was an excellent discussion, and you asked a lot of great questions.